this is Jason from Fix My Books, and today we're talking about opening an LLC in the USA as a Canadian. And these are some things that are going to help save you money. So because I'm about to save you money and also lose money myself, it would be great if you could like, share, and subscribe on the video. Just a brief disclaimer, this video is general information, so you can pick this up from the internet. It's for general information purposes only. Nothing here should be taken as personalized legal or tax advice. I don't even know you. If you're taking this as advice that you're just going to go out and, work off without having someone review your situation, you're nuts. The information in this video is based on current legislation in Canada and the USA, and it's subject to change. It can't fully account for your individual circumstances. And again, if you think it does, you are wrong. Always speak to a professional about your specific situation to have it accurately assessed, and seek advice in each jurisdiction that you may be operating in. So let's get down to it. What is an LLC? Well, it's a flexible entity. It's like a hybrid entity, and it's created under state law in the US. So what is hybrid? Well, that's the flexibility I talk about. It offers limited liability protection to its owners, members, so kind of like a company. So generally speaking, the members aren't personally liable for the business debts or the lawsuit. You really should have good operating agreements when you set these things up, because they will help. And there are some exceptions to this. So you're going to lose your limited liability if you're messy. And what I mean by that is commingling personal and business finances together. So this happens with a lot of small business owners. You have a bank account already. You have personal funds in it, and then you start using it for your business, as well as a business credit or a personal credit card that you start using for your business and personal stuff. That's commingling. Don't do that. It's very annoying for bookkeepers as well and accountants. Just don't do it. People charge you more because you do that. Doing illegal stuff, obviously, is a fraud, that kind of thing. And personal guarantees. So if you're personally guaranteeing a debt, then you're kind of removing the liability there. And what else does it offer as being a hybrid? Well, it gives you that limited liability protection and pass-through taxation. So it's not taxed at the entity level, it's taxed at the individual level. So when you have a profit in the quote-unquote business, it's not taxed at the entity, it's taxed on you. But in Canada, so this is where the issue kind of lies, is it's not considered a hybrid because we don't have these. It's considered a corporation. So it's as if you open just a regular federal or provincial corporation, that kind of thing. So what's pass-through taxation look like? So this is a bit easier to understand. I try to keep these slides a bit more like this in the future, just because it's easier for people, I guess. Single member LLC. So think of it kind of like a sole prop, 0% tax at the entity level. And then the personal level, you've got your personal tax percentages based on the income that goes through, and SE taxes, so self-employment taxes. So in Canada, think of this as CPP. And multi-member LLC, so this is kind of more like a partnership. And again, one that's done on like a T to 125 in Canada, so you can kind of get an idea of what I'm talking about. And again, 0% at the entity level, then the personal level, the individual members are taxed on their percentages. So what does this look like if you were a US tax resident? So if you're a US tax resident, if you had a single member LLC, and you didn't make any elections, it's just a disregarded entity, you'd be filing a 1040, a Schedule C. You probably have other forms that may apply if they're applicable. In the multi-member LLC, you'll be filing a 1065, K1, which are like these sort of partnership slips, and then that would be transferred onto your 1040, and then you may also have other forms that are applicable depending on your circumstance. But it's not always a pass-through. And why is that? Because you can do these sort of elections in the United States where you can want to classify the entity to be taxed differently. So you may want to tax the entity as a C-corp or corporation. There's also something called an S corporation, but I'm not really going to go into this because it's rather complicated and difficult for some people to understand. And you can't open one anyway if you're a non-resident of the US, so you can't make this election. So when you open these LLCs as a foreigner, some different things kind of happen. Since 2017, we've got the Treasury regs there, as well as the IRC section. It's no longer considered a disregarded entity, i.e. a pass-through. It's now considered a corp. So you'd be filing an 1120, you'd be filing a 5472, as well as other forms. 5472 is like an informational form to report transactions between the entity and the individual that owns it, the foreign individual. And since 2021, we've had some developments on the US side for these partnerships with foreign owners. So it would be these K2, K3 informational reports. And, you know, you may be required to file a 1040 NR as well as a foreign partner. And any other forms may be applicable to that circumstance or the individual circumstance at the time. But I just want to introduce a caveat to that, because this is where it kind of gets super confusing for a lot of people, because they're thinking, oh, you know, I'm overseas, I got to file an 1120 pro forma 5472 because it's kind of like it's a disregarded entity, but it's not, because it's kind of a corporation. That's why it's filing this 1120. So it really depends on your circumstance, which is why I always say you really need to talk to someone. Don't just assume that you know because you read online that this is what you've got to file, because this is where a lot of people end up in these really sticky situations. So you may need to file a tax return in the United States if certain circumstances apply. So in this sense, what's happening is you are a disregarded entity on one side, but you are not on another side. So for example, this is when you have something called ECI income, so effectively connected income to the United States. And we're going to get into that in a moment, but we're going to limit it with a very easy example that applies to most people. So this is where the whole double taxation issue arises, because of what I was saying before, where the LLC is considered a hybrid entity, so it's a pass-through in the United States, but in the eyes of most other countries like Germany or Canada, for example, it is considered a corporation. And so the entity is being taxed on one side in the United States at a whole different set of taxes, so personal taxes, and then it's being taxed in the other country where you're domiciled, such as Canada, as a different type of tax, which is corporate tax. And so those two are not the same thing, and that's where you end up with paying double taxes. So this is where these elections that I also spoke about earlier need to come into play. And again, it all depends on your situation. So always have someone look at this. Don't just assume that, yeah, I read this on a blog, therefore citing a blog or citing even citing the IRS publications on the IRS's website as a defense for not having to pay any penalties that may arise is not considered a defense in the US. All right. So just, I think there was a judge that said something along the lines of, you cite the IRS publication, you cite the pubs as at your own peril. All right. So, because it's not law, it's not tax law. So you can't use it. All right. So always have someone look at your situation. So it does sound like a lot of compliance, doesn't it? Yes, it is. And it can be really annoying. It carries a lot of costs and risks associated with it, which people don't really see, because they see this thrill of, oh, I'm going to open a business and it will be a US business and it's going to be fantastic and it makes so much money. But it's not really like that. And a lot of people figure that out once they get into the year end, and there's all this compliance stuff that they got to do. Um, Even opening it can be a bit of a drama sometimes, especially around opening bank accounts, that sort of thing. So you'll need to get an EIN number, which is similar to a business number in Canada. You need to keep accurate records through the year through your bookkeeping compliance. You're obviously going to have to file annual returns for the entity, which are like your uh, annual corporate returns, like minute meetings, that kind of thing. Tax returns for the entity, obviously federal and state, depending on the circumstance. Informational reporting for the entity, and what that is sort of the 5472 stuff I was talking about. So there's a lot of informational forms that can go across with it. And as a Canadian resident individual owning a single member LLC, just as an example, this opens you up to the 5472 reporting that I was talking about before, which carries a 25,000 US dollar penalty for failure to file this form. So it is not a light penalty, and that is just a starting penalty. So when you do this sort of thing, really don't just do it, plan around it if you are going to do it. And this is just the US side of things, because you may also open yourself up to Canadian compliance as well, or you likely will. So does it cost a lot? Yes, it will cost you a lot. The annual filings with the Secretary of State that you're in, where you open the corporation, or the LLC rather, is around 200 to 400 US dollars a year. The bookkeeping and tax filing costs, which depend on the number of transactions that you have, bank accounts, the complexity of what it is that you're doing. A no to low activity with foreign owners LLC is going to cost around 1,000 US dollars to file that tax return. Probably not with any bookkeeping. You can expect between 1,000 US dollars to 10,000 US dollars a year for something full service. But again, it's going to vary depending on the business, the workload, the complexity that you have to do, any tax planning, any strategy that you're doing. It's all going to add to the costs. So, if you had a very, very complex situation, very complex business, multi-jurisdiction or multinational even, you could end up with something like $20,000 to $50,000 a year. It really depends on what it is that you're doing. But we'll keep the example simple because that obviously doesn't apply to everyone. Not everyone has a multinational corporation in their home. And just note that your Canadian compliance is also going to cost you money. So this is the US side of what you're going to deal with, and then you've got the Canadian stuff too. But I always hear this thing where it's like, oh, zero tax, we can pay zero tax, right? Like, because you've watched these TikTok videos, and after you've watched the TikTok videos, you're thinking, oh, I'm just going to open this LLC and there's going to be zero tax and I don't have to pay Canadian tax. The government is just laughing at you when you do this. It's really silly. Please stop listening to these people because they're telling you stuff which is partially true. It's it, I'm getting a lot of calls about opening LLCs and not having to pay any tax whatsoever. And we'll just go to the next slide. But I was told there was zero tax. It's kind of, but it's not what you're thinking of, and it's not how that works. So you have not discovered a tax haven loophole by watching YouTube and TikTok. Think about this problem logically. You are not the first person to concoct this arbitrage scheme, nor would the governments allow this revenue to simply evaporate and they don't collect any of it. I mean, that's insane. You're going to pay tax somewhere. So we're going to use a really common example that is very, very, very common. So if you're in this example right now, this is probably what you're going to be facing. Additionally, if you are thinking of doing this based on this example, this is what you're likely to run into. So you're selling your personal services around the world, not just, in the United States. You may be selling them just in the United States. We'll get into it. So you're providing a service. So you open up a single member LLC in Wyoming because you hear there's zero state tax in Wyoming and it's got all this privacy and it's and your name is Canadian Joe and you own it 100%. Well, we know from the previous slide it's going to be taxed as a C-corp in the US because it's owned by a foreign owner, because you're Canadian Joe, and you're living in Toronto, and you're providing consulting services to Canadian clients, American clients, and others in the EU. And you generate $150,000 in this consulting revenue, and you don't really have any expenses, so it's just making the example super simple. And you do this all from your home in Toronto. So here's Canadian Joe on the side. He's got his office there in Toronto, and then he's Wyoming LLC. So where is this money taxed? Well, it's not taxed at zero everywhere. It doesn't work that way. So is it US source income? Well, we need to refer to the treaty. Business profits of a resident of a contracting state, so in this example, Canada, shall be taxable only in that state unless the resident carries on business in the other contracting state, USA, through a permanent establishment situated therein. This is from Article 7, Paragraph 1. So there's also some other stuff that people need to pay attention to, so dividends, personal service stuff. That's later on in the treaty, but we're just focusing on this for now. So we'll go to the pubs as well. And what that means is we'll go to the publication 519, US Tax Guide for Aliens. All wages and any other compensation for services performed in the United States are considered to be from sources in the United States. Okay. So from this, we've established that there is no tax on the income because it is not performed in the United States. It is performed in Canada from the person's home. So what happens? So it's taxed in Canada, all of it? Yes, it is taxed in Canada, all of it. It was all done by Canadian Joe doing the work from his home in Canada. The $150,000 US is taxed in Canada, even if some of those clients are US based, EU based, it doesn't matter. Work was done in Canada. And I hear this a lot. This is the number one question, but how? It's an American corporation. It should be all separate. I don't have to pay tax there. I don't have to pay tax anywhere. No, that's incorrect. In the US, what it is foreign source income. So none of the income is effectively connected with a US trade or business. But this can change, right? So it's not solid. There are variations to this. And with these variations come a lot more sort of tracking and compliance and stuff that you need to do. So we'll mix it up. Canadian Joe then travels to the US with a valid work visa, like an E2. So no, you can't just travel to the US and then perform work in the United States. You can't do that. You need a visa to do that. And he does some of the work part-time in the US out of a New York office he's created. And he also decides he's going to hire an employee, which is a W-2 employee, so that's similar to a T4 in Canada. And that employee is going to do the work for the US clients and then secure some contracts with US clients. And they're I put them here in California. So now the situation's become more complicated, and now he actually does have effectively connected US source income because the work is actually being performed in the United States. So this is really going to add cost to his United States return because all of this now needs to be separated out. He's also going to have some issues potentially with Nexus, which is some sales tax issues because he's selling multi-jurisdictionally. It depends on what it is that he's selling. In this situation, it's just consulting services, so he may not, but he's also got permanent establishment risk in New York, potentially California, even though it's a Wyoming LLC. So there's a whole myriad of things that goes on, and it makes the situation more complicated. We don't have enough information in this very brief example to ascertain what is going to be his tax situation fully, but I just wanted to give you an example of how just adding in a couple of variables makes things vastly more complicated and changes the entire situation for this person. So we'll just go back to the original example so that you can see how things sort of flow. So single member LLC opened in Wyoming by Canadian Joe, owned 100%, taxed as a C-corp in the United States is 1120, but there's no tax because Joe is living in Toronto and he provides the consulting service to Canadian clients, American clients, and other clients in the EU. He generated 150,000 in revenue and it was all done from his home, so it is Canadian source income. So does he have a Canadian tax mess now? Kind of. He's going to need to report his corp ownership on something called a T1134. It's a very, very complex form. If you read it, you'll see that it's ridiculously complicated. So always seek help with this kind of thing. It, you're obviously going to, this is after you've done the American financials, that kind of stuff. You're going to need to register for a business number in Canada because now it's Canadian source income. It's a business operating in Canada, even though it's opened in Wyoming. He'll need to register for GST, HST, and or PST if it's applicable, because his sales were greater than 30,000 Canadian dollars, so he isn't a small supplier. He was foolish because he didn't actually charge GST, PST, HST, whatever was applicable, because he didn't think he needed to. And now he can't go back and charge those clients in Canada. So he now needs to remit the amount that he needs to pay anyway. And there goes some of his profit. He'll also need to file a Canadian T2 tax return and then pay taxes on his Canadian source income in Canada. On top of that, he's going to lose the small business deduction because it isn't a CCPC, Canadian Controlled Private Corporation. And then he's not going to have those favorable tax rates on profits. He's also got to watch out in the future for permanent establishment risk and branch taxes. So I'm not going to get into that because that's super complicated, but that's also something he has to watch out for, which can add another 25% taxes. So yeah, kind of a bit of a mess. So does it cost a lot? Yeah, it's going to cost a lot in Canada. His corporate filings that he has to do every year to keep his company in compliance, $200 to $400. He's going to have bookkeeping and tax filing costs, and depending on the level of transactions and complexity, again, they're going to be up there. He's got the foreign reporting, which can start, sometimes see Canadian $800, and it goes up from there. It can be several $1,000s depending on how complicated he's made it with how he moves his money, etc. No to low activity for a T2, he's probably looking at 1,500 Canadian dollars. And he's going to have to expect to pay between 1,000 to 10,000 Canadian dollars a year for full service stuff. So it's obviously, again, going to vary on the business, the workload, complexity, tax planning, tax strategy, what is he doing internationally? That's all going to be factored in to the costs that he's going to have to pay. And this is the Canadian side. So now you've opened yourself up to double costs of compliance. But then you have to think about the profit, right? It's going to be taxed at this 26.5% because it's taxed at the corporate level. It doesn't have those favorable small business deduction tax rates. And I always hear this one by people saying management fees, just pay it as management fees. So you can do that, but it does make the situation a little more hairy and irritating in terms of compliance again, but also in terms of costs. So now Canadian Joe will need to get a business number for himself as a sole proprietor. He'll need to register for GST HST because he's going to receive over 30,000 Canadian dollars. Then he's going to pay anything that he needs to pay in terms of his GST HST. He'll need to file a T1, T2125. He'll need to pay employment taxes on that and CPP anyway. All right. So what can this sort of quote unquote kind of foreign but not foreign corporation, which is a LLC, do? Well, it's kind of more sensible to move the money out as employment income. So the LLC can file a T4. It doesn't have to do any GST, HST on that. It just pays the payroll taxes and CPP because the the work was performed in Canada. So it's just like filing a regular T4. Canadian Joe gets his T4, puts it with his T1, files that, and he's done. So what did we learn with this exercise? You're probably going to pay the same amount of taxes because it's all Canadian source income anyway, so you might as well have just gone and opened a Canadian corporation and paid yourself payroll. Would have been just as simple, and you actually would have paid less taxes. You're going to pay a lot in compliance costs. So US compliance costs, Canadian compliance costs, you're just doubling your costs. You're looking at some of the most complicated type of tax work and bookkeeping work. Because not only the stuff that you deduct in the foreign company has to comply with the foreign laws, but those deductions also need to comply with the local laws because the work is being, Canadian source. So you need to be doubly compliant, and you need to have people that know both sides of the situation. It's usually why this is not open to smaller firms and smaller people, and they need to reach out to very, very large firms, and it costs a lot of money because, I mean, their tax software on some of them costs over $10,000 a year to, I've seen quotes of $50,000 to $100,000 a year just for the tax software. So what they do, or what we do as well, is it's very complicated stuff. It isn't easy. You've also compounded the risk for yourself. So you've got these risk of misfiling, and that's that 5472 stuff, T1134, so it comes with very hefty penalties, and you've just increased this risk by 100% from zero. So you have to think about that when you factor this stuff in. You're going to attract a lot more scrutiny to your tax return for little to no reason, because you could have just filed a T2 and had a corporation in Canada and take advantage of small business deduction, etc. And now you're going to spend a lot of time messing around on compliance stuff in two countries when you could have just worked a little more and earned more money. You've actually just saddled yourself with costs instead of freeing up your time to earn more money. So it's something that a lot of people don't really learn until they go through it, unfortunately. But that's why I'm making this video, because I feel bad for a lot of people that do this, and then they end up with this very hairy situation that's difficult to deal with. So since I just saved you about $5,000 in ridiculous costs, and I'm not going to make any money, it would be really cool if you can like, share, and subscribe, because that would help us. And just remember that there is no free lunch in this, and now this is you planning ahead and making sure that you don't waste money on ridiculous services that you don't actually need. And again, this is Jason from Fix My Books. If you're in this situation, you know anyone in this situation, or if you need a hand with a similar situation, feel free to reach out. Thank you.